On April 22, 2025, at 9:47 a.m. Eastern Time, something happened that most economists said was impossible. Gold hit $5,000 per ounce, not gradually, not predictably. It punched through the barrier like it was made of paper, kept climbing, and by lunch had settled at $5,080. Silver, gold's volatile younger sibling, jumped 18% in a single session. The financial press called it breathtaking. Central bankers called it profoundly scary. And if you're wondering why grown adults who manage trillions of dollars are using words that sound like they're describing a horror film, well, that's because in a way, they are. This isn't a story about people getting rich. This is a story about people getting nervous, very, very nervous. Let's establish something right away. Gold doesn't produce anything. It doesn't pay dividends. It doesn't grow crops or generate electricity or cure diseases. You can't eat it, burn it for warmth, or use it to build a house. What gold does is sit there, quietly, waiting, and for most of modern history, that's been enough. Because gold has one job. It's the thing you buy when you stop believing in everything else. It's the financial equivalent of a bunker. And right now, apparently, a lot of very smart people are heading for the bunker. The rally started in late 2024, but nobody paid much attention at first. Gold was at $2,650 an ounce in November. By January 2025, it had crossed $3,200. Analysts called it a correction, a temporary flight to safety, the usual geopolitical jitters. Then February happened, then March, the price kept climbing, and the explanation started getting more creative. Supply constraints, dollar weakness, central bank buying, inflation hedging. But here's what makes this rally different from every other gold surge in the past 50 years. It's happening while almost everything else is also going up. Stocks are near all-time highs. Real estate is expensive. Bonds are, well, bonds are complicated, but they're not collapsing. Usually, gold rises when everything else is burning. This time, gold is rising while the party's still going. And that, more than the price itself, is what has people spooked. To understand why this matters, you need to understand how gold actually works in the global financial system. And I don't mean the Commodity Futures Market or the London Bullion Market Association, though those are important. I mean the psychology. Every major currency on Earth is what's called fiat money. It has value because governments say it has value and because people agree to pretend it has value. That's not a criticism, that's just how it works. The dollar in your pocket is worth something because the US government backs it and because everyone else accepts it for goods and services. This system works brilliantly, right up until the moment it doesn't. Gold exists outside this system. It's not backed by any government. It can't be printed or digitized or created with monetary policy. There's a finite amount of it on Earth, approximately 208,000 metric tons ever mined in human history, and getting more requires digging very deep holes in very remote places. For the past 40 years, since the US fully abandoned the gold standard in 1971, gold has been in a weird limbo. Central banks still hold it, about 35,000 tons combined, but officially, it's just another asset. An insurance policy gathering dust, except when the insurance policy starts doubling in price in 6 months, you have to ask, what exactly are we insuring against? The mechanics of this rally are actually straightforward. Central banks, especially China, Russia, India, and Turkey, have been buying gold aggressively since 2022. They purchased over 1,000 tons in 2024 alone, the second highest annual total on record. At the same time, retail investors started piling in. Gold ETFs saw inflows of $90 billion between November 2024 and March 2025. Mining stocks tripled. Even crypto investors, the people who spent a decade calling gold a boomer rock, started buying physical bullion. The catalyst seems to have been a combination of factors. Persistent inflation that won't fully die. geopolitical tensions that won't fully resolve, debt levels in developed economies that won't fully stabilize, and, perhaps most importantly, a growing sense that the traditional playbook for managing these problems ain't working anymore. But here's where it gets interesting. The math doesn't quite add up. Gold at $5,000 an ounce means the total above-ground supply is worth approximately $34 trillion. That's more than the annual GDP of the United States. It's roughly equivalent to the combined stock market value of the 10 largest companies on Earth, for a metal that doesn't do anything. Now, in theory, this makes sense if you believe currencies are losing value faster than anyone admits. If the dollar, euro, and yen are all slowly melting, then gold should rise to reflect that. It's not that gold is getting more valuable, it's that paper is getting less valuable. But here's the uncomfortable part. Inflation, by official measures, isn't running at hyperinflation levels. The U.S. Consumer Price Index is running around 3%. Europe is similar. These are elevated numbers compared to the 2010s. Sure, but they're not Weimar Republic numbers. They're not Zimbabwe numbers. So either the official inflation statistics are missing something very large, or gold is pricing in something that hasn't happened yet. The silver rally makes this even stranger. Silver hit $48 an ounce in April, its highest level since 2011. Silver is an industrial metal, used in solar panels, electronics, batteries. It should track with economic activity. When factories are humming, silver rises. When factories slow down, silver falls. Except this time, silver is rising alongside gold, almost in lockstep. That's unusual. It suggests investors aren't buying silver for its industrial uses. They're buying it because it's gold's cheaper cousin, and they've been priced out of the gold market entirely. There's a term for this in finance, panic buying, and panic buying, historically, doesn't end well. If you've spent any time on financial social media in the past few months, you've probably seen the headlines. Gold to $10,000, silver to $100, the everything collapse. There's a cottage industry of analysts who have been predicting this for decades. They were wrong in 2008, wrong in 2015, wrong in 2020, and now, suddenly, they're not wrong anymore, or at least, they're less wrong. The problem with being a permabear on the financial system is that you sound crazy right up until the moment you sound prophetic. And it's very difficult to tell which moment you're in. The reality is more nuanced. Gold at $5,000 doesn't mean the financial system is collapsing. It means confidence is eroding. Those are related but not identical concepts. Collapsing would mean ATMs don't work, grocery stores are empty, and governments lose the ability to enforce order. Eroding confidence means people start moving money quietly, hedging baits, preparing for scenarios they hope won't happen. The distinction matters because eroding confidence can reverse. It's happened before. Gold peaked at $1,900 in 2011, then spent the next 5 years declining as the global economy stabilized. By 2015, it was back under $1,100. Everyone who bought at the top lost nearly half their money. But there's a difference this time. In 2011, central banks were still seen as competent. The Federal Reserve, the European Central Bank, the Bank of Japan, they had credibility, they had tools, they had plans. In 2025, that credibility is fraying. Not gone, but fraying. Central banks spent the past 15 years deploying emergency measures, zero interest rates, quantitative easing, direct market interventions. These were supposed to be temporary. They became permanent. And now, with inflation proving stickier than expected and debt levels higher than ever, the toolbox looks a lot emptier than it used to. Gold isn't rallying because the economy is collapsing. Gold is rallying because people are starting to wonder if the people in charge actually know what they're doing. That's a much scarier question. So, what happens next? There are essentially 3 scenarios, and none of them are particularly comforting. Scenario 1. Central banks get inflation under control, confidence returns, and gold slowly deflates back to something like $3,000 or $3,500 an ounce. This is the soft landing scenario. It's possible. It's just not very likely given how many things have to go right simultaneously. Scenario 2. Gold continues climbing, but slowly. $5,500 by the end of 2025. Maybe $6,000 by 2026. This is the new normal scenario. Gold becomes a permanent fixture of portfolios at elevated prices. Wealth shifts quietly from paper assets to hard assets. The global financial system adapts, but it's a different, less stable system than the one we've lived in for the past 50 years. Scenario 3 is the one nobody wants to talk about in polite company. Gold doesn't stop at $6,000. It blows through $7,000, $8,000, $10,000. At that point, you're not looking at a bull market in gold. You're looking at a bear market in everything else. Currencies, bonds, trust. Historically, when gold goes parabolic, it means something structural has broken. And in a global financial system built on debt, leverage, and confidence, structural breaks propagate very quickly. The irony is that gold's rise creates its own problems. If everyone tries to hedge against currency debasement by buying gold, they drive the price so high that it becomes inaccessible to ordinary people. Gold becomes a rich person's hedge, which means wealth inequality accelerates, which means social instability increases, which means more people lose faith in institutions, which means gold rises further. It's a feedback loop, and feedback loops don't end gently. Here's the thing about gold at $5,000. It's not just a price, it's a signal. It's the financial system's check engine light. And maybe the engine is fine. Maybe it just needs an oil change. But when the light's been on for 6 months and the mechanics keep telling you not to worry about it, at some point you start wondering if maybe they don't know what's wrong either. The rally has been called breathtaking. It's been called profoundly scary. But what it really is, more than anything, is revealing. It's revealing what people actually believe when they stop listening to the reassurances and start listening to their gut. And their gut is telling them to buy something real, something old, something that's been a store of value for 5,000 years. Which raises the question, if this is just a temporary blip, a momentary panic, why are central banks buying too? They're the ones who are supposed to know better, unless, of course, they don't. Gold is at $5,000. The question ain't whether that's high. The question is whether it's high enough.